Luke Ciciliano has been a freelance developer for many years. In this course, he will teach you how to manage your taxes as a freelance developer. This course will be especially applicable to people living in the United States.
Hi, my name is Luke Ciciliano. I'm a self-employed web developer. I've done a few articles and videos for FreeCodeCamp on various issues related to how self-employed developers and freelancers can better manage their business, can make more money, can get customers, things of that nature. I've decided to expand on those discussions with this video and a written article that's going along with it. That written article will be linked to down below. Um, and the discussion in this video is going to be one of the topics that might cause self-employed people more frustration than anything else, and that is the management of your taxes. Obviously, if you've worked for yourself, you know taxes can be frustrating to deal with. It can be confusing. So the goal of this video is really going to be to clear up quite a few things and hopefully help people keep a little bit more of what they make. Now, before I get into what all is going to be covered in this video, the one thing I really want to stress is that I am not holding myself out as a licensed tax professional. I am not a licensed tax professional. No one at FreeCodeCamp is holding themselves out as tax professionals. This video should not be taken as professional tax advice. Everything I'm going to be saying is just matters of personal opinion, and it only relates to how I do things in my business. In terms of your own personal situation, you really do need to discuss it with a CPA or a tax attorney or someone of that nature. With that being said, I have been working for myself for quite a few years, and fortunately, I've been able to get good tax advice along the way. So what I'm going to be just doing in this video is sharing a little bit of just personal knowledge, personal opinions, and things of that nature. So again, if you've worked for yourself, you understand how frustrating it can be dealing with taxes, not just filing your returns, but things you've got to file every quarter, if not every month, managing withholding, things of that nature. So what we're going to be getting into in this video is a number of topics. Number one, we're going to talk about why taxes matter. In other words, why you really need to be mindful of what you're paying to various governmental entities in income tax. This taxes tend to be something where a lot of people just think, well, they're my taxes, there's nothing I can do about it, I pay what I pay. Whereas the truth of the matter is, you can really get ahead financially by being more mindful of your taxes than most people are. Okay, so the first thing we're going to look at is why taxes matter in the first place. The second thing we're going to look at is some important concepts to get our arms around before we even really dive into how to maximize deductions and things of that nature, because understanding how taxes in the US work on a basic level is important to understanding how you're going to get the most out of your various deductions and how you're going to get the most out of your opportunities to save some money on what you send to the government. The third thing we're going to look at is the fact that how you structure your business is going to impact how much you're paying in taxes at both the federal level, the state level, the local level, et cetera, et cetera. So how you structure your business is actually going to have a very big impact on your tax bill at the end of the year. The fourth thing we're going to look at is maximizing your deductions. In other words, making sure that you aren't missing deductions and as a result over-reporting your income, and as a result of that paying more in taxes than you need to at the end of the year. You'd be surprised at how many people miss really important deductions. The fifth thing we're going to look at is how you can go about making your payments to the government during the year, because when you're an employee and you get a W-2 and you get a paycheck every week or every 2 weeks, you're used to your employer holding out your taxes and managing all that for you. Well, now that you're self-employed, you got to do that yourself. So it's really important to know how you go about making your payments during the year. And the sixth and last thing we're going to look at is something that a lot of people don't stop to think of, and that is the fact that where you live in the United States really impacts how much you're paying in taxes. So let's take a look at each of these, and just remember that this course is really meant to only, I shouldn't even say really meant, is meant to only deal with taxation in the United States. I have no personal experience paying taxes in other countries. I have no personal knowledge of or opinions about tax structures in other countries. So this deals with the US only. Okay. So with all that said, let's get to it and talk about why you should be mindful of your taxes in the first place. Okay, so the first point I want to get into is the importance of being mindful of your taxes in the first place. Unfortunately, quite a few people, and most people for that matter, see their taxes as something they just have to pay. They think there's nothing they can do about it. They think there's nothing they can do to control how much they're paying in taxes. And most of those same people also aren't aware of just what their taxes mean to their financial standing. Okay. For most people, and I do mean the overwhelming majority in the United States, if their taxes aren't their largest bill during the year, they're probably the second largest bill. And for most people, they are the largest bill. It's just unfortunately people don't think of it in those terms. Whenever I have this discussion with people, one way I always challenge individuals to look at it is to say, hey, what are your two biggest expenses? And people will usually list their housing, number one. And then for number two, they might list a variety of bills, maybe healthcare premiums, maybe a car payment, whatever. Um, but then if you say, really, do you really think those are your two biggest expenses? And they stop to think about it for a minute, they realize they're actually paying more in taxes than, whatever they're paying for that number two bill, or usually they might even be paying more in taxes than what they're paying for housing. Okay. So your taxes really are just a really large amount of money that, you're paying out all the time during the course of the year. And by being mindful of that, you can get that tax bill down, which leaves a lot of money in your pocket at the end of the year. Because it's really important to just be mindful of the fact that it's really hard to get ahead if somebody's just taking a huge chunk right off the top, right? So really be thinking of how do I get my tax bill down, and that's what we're going to be getting into a little bit over the course of this video. By being mindful of your taxes, I really do think you will find that you can get ahead financially in this world a lot faster than you would otherwise. Because again, as I said a moment ago, it's hard to get ahead when somebody's taking a chunk off the top. But one thing to be mindful of, and I know I'm going to catch a lot of flack and might even get some negative comments over saying this, is that a lot of today's discussion about income inequality and a lack of opportunity and things of that nature kind of misses the point when it comes to the U.S. tax code. Um, a lot of people think the tax code in the United States is set up to favor wealthy people and things of that nature. The U.S. tax code is actually not set up to favor individuals. It's set up to favor activities. Okay, it is set up to favor people who run businesses and who invest. All right. So if you're not running your own business, which if, as a freelancer, you're running your own business, but if you're not running a business, which even if it's a solo business, and if you're not investing, you're going to wind up paying a lot more in taxes. So by going the freelance route, being mindful of your taxes and investing, you can really get that tax bill down, and you will just keep a really much larger proportion of what it is you're making. And as a result of that, you have more money to invest, and then that allows you to get ahead financially. Okay. Don't fall into the trap of thinking that uh, worrying about one's taxes is something that financially comfortable people do. Okay. Financially comfortable people don't worry about their taxes because they're financially comfortable. One of the big reasons they're financially comfortable is because they worry about their taxes. Okay. So by engaging in activities such as working for yourself and investing, which we're going to get into in this video, you can really get your tax bill down and get yourself in a better spot. All right. So be very mindful of your taxes. Understand it's one of your biggest expenses, and understand you have a lot of control over how much you pay, like in taxes. You just need to be mindful of it, and it's something you need to always be thinking about. I mean, if you're watching this video, chances are you think about other expenses. You think of, how do I get my housing bill down? How do I get my gas bill down? How do I get any number of bills down? Start thinking that same way when it comes to what you're paying out in taxes during the course of the year. So with all that being said, let's look at some important concepts that we need to get our arms around in order to understand how you can get your tax bills down. Okay, so there's a few different concepts we need to look at to, like I said earlier, get our arms around how the tax system works so we can then understand how to save money on taxes as a self-employed developer or a freelancer of any kind for that matter. It doesn't matter if you're a freelance writer, freelance developer, freelance, you name it. all these same tax rules are going to apply. So this is relevant to anybody who's self-employed. So these concepts we need to get our hands around that a lot of people may struggle with or just simply be unaware of is number one, understanding the difference between revenue and income. Number two, understanding how an employee is taxed versus how businesses and business owners specifically are taxed. Number three, we need to look at an explanation of the different kinds of taxes that we have here in the United States. We have federal taxes, state taxes, local taxes, and even those get broken up into various subsets. Also, we need to understand how graduated tax brackets work. And then also we need to understand the differences between taxes paid for the year and then taxes paid in during the year, which are two different things. So like I said, these are all concepts that if you ask people about them, they may not really be able to explain it very well, or they just may not be aware of how they work. So let's take a look at each of these in turn, okay? So in terms of understanding the difference between one's revenue and one's income, okay? When you work for yourself, revenue is what comes in the door. So in other words, if you're building an app for somebody, if you're a freelance writer and you're writing like an ebook for somebody and they pay you $5,000 to do it, you have made $5,000 in revenue. However, you have expenses in running your business. Okay, so let's say you have $500 in expenses, $100, whatever, in expenses in running your business. That revenue minus those expenses is your profit, or in other words, your income. So your income is not what you bring in, it is what you keep, which is your revenue minus your expenses. So I'm going to put up a slide, and as you can see, my slides are not exactly a work of art. I also don't, in addition to not holding myself out as a tax professional, I don't hold myself out as an artist. But under our example here, if someone brings in, again, using my example from earlier, let's say you bring in $5,000 in revenue. So in other words, someone pays you $5,000 to do work for the month, let's say. And then during the month, you spend $200 in advertising. You pay out $50 for, let's say, business insurance. Let's say you pay out $50 for software subscriptions, AWS, maybe a G Suite account, things of that sort. So in other words, after your revenue and then your $300 of expenses, your net income is $4,700. So what you made was not $5,000. What you made was $4,700. Okay. And I talk to self-employed people all the time that if you ask them what they make, they actually tell you their revenue number as their income, not their profit, which if they're reporting their taxes that way, then they are paying way too much in taxes because they're paying taxes on $5,000 worth of income versus $4,700 worth of income. And you're only actually required to pay taxes on your income, not your revenue. So it's really important that you understand the difference between revenue and profit slash net income, and that you're reporting that correctly. Okay. So remember, you pay taxes on your income, not your revenue, and it's important that you understand the difference between the two. Another thing to really understand is the difference in how you're taxed when you're an employee versus when you're a business owner. If you're an employee in the United States, that means you get a W-2 at the end of the year. You get a paycheck every week, every 2 weeks, and you are the most taxed individual in the United States, okay? Because employees in the United States, they get taxed on they pay federal income tax on all their income. They pay Social Security tax, otherwise known as FICA, and Medicare on essentially all their income. And they also pay state and local income tax on, if that's applicable, on all of their income. So when you're an employee, yeah, you're getting a paycheck, and your taxes get taken out of it, and you're being taxed on a higher percentage of your income than people that work for themselves. So, but if you are getting a paycheck from somebody and getting a W-2, you are an employee. Okay. Now, that is, being an employee is different than being a self-employed person, a freelancer slash business owner. Because when you're a freelancer, you really are just a business owner, and even if you're only even if you're the only one in your business. So for the purposes of our discussion in this course, we're really going to look at three different kinds of business structures that exist in the United States. One is a sole proprietorship, which a lot of freelance workers are going to go this route. A sole proprietorship is just that it's sole, meaning, you know, you haven't gone out and formed an actual company. You're just doing it as an individual. Maybe you got some people working for you, but typically not. A sole proprietor is usually just themselves, and they haven't formed a separate entity. They haven't formed a business. Like they haven't started like a corporation or an LLC or something like that. So the first kind of business form we're going to look at is a sole proprietor. And again, that's just you have not started a separate entity. Okay. The second kind that we're going to look at is an LLC, which is a limited liability company. As a as opposed to a sole proprietorship, an LLC is an actual separate entity. An LLC can buy property, sell property, has its own bank accounts, things of that nature. So if you if you're working for yourself and you form an LLC, then you have formed an actual legal entity that you're doing business through. The third kind of business structure I want to look at is what's called an S corporation. I'll spare you why it's called an S corporation, but you can actually choose to have your LLC taxed as if it were an S corporation. You don't have to form an S corporation. You can form an LLC and elect to have that treated as an S corporation. We'll talk that a little bit later in the video. So for tax purposes, if you're working for yourself, chances are you're either going to be taxed as a sole proprietorship, you're going to be taxed as through an LLC, or you're going to be taxed through an S corporation. Okay, those are the three main that you're going to be falling under if you are working for yourself. So again, if you're an employee, you get a paycheck, your employer manages all your withholdings, you're paying taxes on all of that. If you are working for yourself, you're probably either a sole proprietor, an LLC, or an LLC being taxed as an S corporation, and you actually get some tax breaks that way by structuring your business. Okay, so understanding, in addition to understanding the difference between revenue and income, you need to understand the difference between being an employee and being a business owner. Okay. The third thing we really need to understand in terms of core concepts is that there are different levels of taxation in the United States. A lot of people talk about their taxes and lump it all into just kind of one bucket. Again, there are different levels of taxation in the United States. First, the federal government is someone you're going to be paying money to, and you are going to pay that in the form of federal income tax. Federal income tax is what the government uses to run operations, things like run government offices, fund the military, things of that nature. So your federal income tax, you pay the federal government, that funds the government on a day-to-day basis. You also pay FICA, which is Social Security, and Medicare tax to the federal government. Those specifically go for funding Social Security payments to people and funding the Medicare system. So those are all taxes you pay just to the federal government: federal income tax, FICA, and Medicare. But then you're also going to be paying state income tax in some states, not others. Okay, it depends where you live. Like if you live in California, for example, you're going to be paying income tax to the state. Some states don't, like Nevada, don't require the payment of any state income tax. And in some states, if you're there might be state income tax, but if you're self-employed, there's no state income tax. We'll get into all that in a little while. But for right now, understand that there are different levels of taxation. There's federal taxation, which can be broken off into several subsets. There's state level taxation, and then you might even also pay local taxation. So if you live in the wrong place, you might be paying federal income tax, you might be paying income tax to the state you live in, and then you might be paying some form of income tax to the city you live in on top of that. So the third core concept that we need to understand is that the federal tax system works through what are called graduated brackets. All right. You might hear people all the time say things like, oh, I'm in the 22% tax bracket, or they'll spit out a number. And there tends to be a lot of misunderstanding about what a tax bracket means. If you were to tell somebody, and again, I'm just using the numbers to prove a point. If you were telling somebody, hey, I'm in the 22% tax bracket, that person might think that means you pay 22% of all of your income to the federal government. Okay. But that is not how tax brackets work. And to understand tax brackets, I'm going to put up a different slide. And again, here's another one of my ugly slides. The US tax brackets are, for the federal system, are graduated. And by that I mean uh, up to a certain point, you'll pay a certain rate, and then after that, you'll pay another rate, and then after that, you'll pay another rate, and so on and so forth. So, under my scenario here, let's say somebody's making $40,525 for the year in taxable income. Again, their taxable income is $40,525. What you'll see is in the United States, this is for 2021, again, the 2021 tax year, you would pay 10% of your first $9,950 in federal income tax. Okay. Any income after $9,950 would get taxed at 12%. So, in other words, the 12% bracket starts at $9,951. So, that $9,951st dollar would have 12 cents taken out of it for federal income tax. Okay, so in other words, these brackets are graduated. So whenever you hear somebody say, I'm in the 22% tax bracket, for example, that means some of their income they paid 10% at, some of their income they paid at a higher bracket, some of their income they paid at a higher bracket. And it's not really, it's not accurate to say all their income was taxed at 22%. What it is that their highest bracket they broke into was 22% if somebody's saying they're in the 22% bracket. This slide is all of the IRS tax brackets for 2021. So you can see your first $9,950 of taxable income is taxed at a rate of 10%. Taxable income between $99.50 and $45.25 is taxed at 12%. Okay. Income between $45.25 and $86,375 is taxed at 22%, and so on and so on and so on. So again, as you can see, if someone were to tell you, "Hey, I'm taxed in the 37% bracket," all they're saying is that they had taxable income of over $523,601, and some of their income was taxed at 37%. So understand that tax brackets are graduated and you pay a portion of your income at different rates, okay? But there tends to be a lot of misunderstanding when it comes to tax brackets and how that works. It's really important you understand that graduated structure and that earning a certain amount can push you into a higher bracket, and if you keep your income down, you stay at a lower bracket. Okay, and you keep your income down by capturing deductions, which we'll get into shortly. The last core concept that we need to understand is the difference between taxes paid for the year and taxes paid in during the year. These are two different things. So a lot of people, when they get their paycheck from their employer, and I'm just making up numbers to prove the point, they see that their employer held, $500 out of their paycheck for taxes. They think they paid $500 in taxes. What they did is they paid in $500 in taxes towards their annual tax bill. At the end of the year, when you complete your 1040 form, that 1040 form is going to say, here's what you earned, here's what your tax obligation is based on what you earned, and then it's going to look at what you paid in during the year, which are those withholdings if you're a W-2 employee. And if you paid in more than your tax obligation, you get a refund back for the difference. If you paid in less than the tax obligation, then you owe the government the difference. Okay, so paying in taxes during the year is not paying your taxes. You don't know what you pay in taxes until you do your 1040 at the end of the year. And again, what what your tax obligation is then charged against whatever you paid in during the year. So understanding the difference between what you're paying in during the year and the fact that your tax obligation is not calculated until the end of the year is a very important concept, for people to understand. All right. So now that we've been over each of those things, you'll remember a moment ago we talked about there are different ways you can structure your business. As I was saying, you can either be a sole proprietor, an LLC, or you can be taxed as an S corporation. Now, while all those structures have benefits that exceed being a W-2 employee, there are different levels of taxation and tax breaks that can apply to those different kinds of businesses. So let's take a look at how each of those different kinds of entities are taxed, okay? And understanding how those entities are taxed can go a long way towards helping you understand how you want to structure your business. Okay, in the last part of our video, we talked about the three kinds of business structures you can have, generally speaking, if you're going to be a freelance developer or freelancer of any kind. And those business structures are typically going to be either a sole proprietorship, forming an LLC, or forming an LLC with what's called an S corporation election. Okay, so in this part of the video, we're going to look at the tax benefits and consequences of each of those. And before we do that, though, it's important to understand something called the qualified business income deduction. So the first thing I'm going to do is explain the qualified business income deduction, which is commonly referred to as the QBI. And then we're going to look at, again, the consequences of how of choosing one of those different business structures and see what kind of benefits you get on your taxes for that. The first thing to understand in this is the qualified business income deduction. The QBI came about as part of the 2017 Tax Cut and Jobs Act. In other words, the tax cut law that was passed in 2017 created the QBI, which is something new to the U.S. tax code. And what the QBI does is, for self-employed people, it makes the first 20% of your business profit non-taxable, generally speaking. There are some exceptions to this. But as long as your total income for the year from all sources is less than $164,900 for 2021, you will not pay federal income tax on the first 20% of any income that is related to your freelance business. Again, generally speaking. Okay, so how does this work in practice? So to understand this, I'm going to go ahead and put up another one of my ugly slides. I am a better web developer than a slide maker. But again, this is just a really simplified breakdown of the qualified business income deduction for someone in 2021. Let's say somebody was a freelance developer and they had no source of income other than their freelance business. They earned $100,000 in revenue. Again, we talked about revenue earlier. That's the total of what came into the business. But then the business had expenses on top of that. So let's say you had one expense that was $5,000. You had another expense that was $5,000. So you have net income of $90,000. Okay. But the thing is, while somebody who's earning a W-2 is going to be looking at federal income tax on $90,000 worth of income, if you're self-employed and you get to take that QBI deduction, you take the first 20% off. So you only pay federal income tax towards $72,000, not towards the $90,000. In other words, the simplest way to think of this is that the first 20% of business-related income for a freelance developer gets skipped out of federal income tax, okay, which can really go a long ways. So the QBI is going to apply to all levels of self-employment, whether you're a sole proprietor, whether you're running an LLC, or whether you're being taxed as an S corporation. Okay. So just by running your own business in general, you're going to get a big tax break over somebody who is working a W-2 job due to the QBI. So now that we've talked about how the QBI works, let's understand some of the benefits of, and detriments, I should say, along with the benefits of these different business structures. If you're a sole proprietor, you have taken the easiest route for starting your business. Okay. A sole proprietor is somebody who is doing freelance jobs on the side on a continuous basis and getting a 1099 at the end of the year, and or somebody who has gotten a general business license and started a trade name, but they haven't gone out and actually started a company. In other words, they just went to the Secretary of State's office and got their business license, started their trade name, and and they're running everything that way. Those that is the easiest way to start up. That is the least expensive way to start up. That is the way to start up that involves the least amount of paperwork. Okay. So either the 1099 route or the actually getting a business license is what a lot of people are going to do. When you do that, you get to take the QBI on your profit, meaning your profit in your business is your income minus your expenses, and then you're only going to pay taxes on 80% of that profit. That's federal income tax. You will pay self-employment tax, which is the equivalent of Medicare and Medicaid, on all of your income. Okay, so under the scenario I put up a minute ago, if somebody's earning $90,000 after their expenses, they'll pay employment taxes on the whole $90,000 and federal income tax on $72,000. They'll also be subject to state and local income tax depending on where they are. So sole proprietorship is going to mean the least amount of hassle and aggravation getting started. You're going to save on taxes because of your QBI, and there really aren't going to be any benefits to it after that. Okay. If you form an LLC, you have formed a separate actual entity. An LLC is a legal entity apart from its owner. Okay, it's a company. It can buy property and sell property in its own name, things of that nature. It gives you liability protection. There are other benefits that come with owning an LLC. If you do an LLC and choose to not have it taxed as an S corporation, then all the money from the LLC on your will flow through to you on your tax return. The LLC pays no taxes during the year. So what will happen here is if the LLC has $90,000 in profit, the owner of the LLC will then report $90,000 of income on their personal tax return. Okay. There are benefits to owning an LLC outside of taxes. Those benefits include liability protection, the ability to bring in partners easily, things of that sort. But for tax purposes, owning the LLC and being a sole proprietor, if you're a freelancer, really aren't going to be that different. You'll get the QBI deduction, which again saves you money over having a W-2 job, but you're also going to pay self-employment taxes, which are the equivalent of Medicare and Medicaid. So tax consequence wise, LLC with no S corp election and sole proprietor, both better than getting a W-2 job, and not much else other than that QBI benefit. Keep in mind, with the LLC, you have started an actual company, which means there's more paperwork and hoops to jump through to maintain that than just being a sole proprietor. The third step on the spectrum we've been talking about would be to form an LLC and have it taxed as if it were an S corporation. What happens when you do this is you form an LLC, the company is an LLC, but the IRS kind of just says, for tax purposes only, we're going to pretend as if it's an S corporation. And what happens when you own an S corporation is you are an employee and the owner of the business simultaneously. So as the employee, you have to pay yourself a reasonable salary. And I got to stress the reasonable part. You can't just pay yourself $1. You've got to pay what someone doing the work you do would reasonably make. So if a reasonable developer salary is $60,000, you need to pay yourself a salary of $60,000. That salary will be taxed like any other paycheck would for a W-2 employee because, again, you've got to pay that salary through a payroll service or something of the sort. So you're going to pay taxes on that just like any employee would. The profits, however, on top of the salary in an S corp is where you really start to see the tax benefits of this, because those profits are subject to the QBI, meaning that the first 20% of those profits are not subject to any federal income tax. Those profits are also completely exempt from self-employment taxes, meaning you will pay nothing equivalent to Social Security, Medicare, Medicaid on that. So no employment taxes and only federal income tax on 80% of those profits. So if you have your reasonable salary and a lot of profits on top of that, all this profit is really tax advantaged because you're paying no Social Security, Medicare, Medicaid on any of that, and you're only paying federal income tax on 80% of that. The downsides of an S corporation is, again, you've got to pay yourself a reasonable salary as an employee, meaning you've got to go through all the paperwork that goes with having an employee yourself. So we pay a service, Intuit Full Service Payroll, to manage that for us because we are taxed as an S corporation. I'm going to link to Intuit Full Service Payroll, I should say. Intuit Full Service Payroll will be linked to below. So in other words, there's expense. If you're going to run an S corp, there's expense you have to incur, mainly the payroll service, and there's hoops you have to jump through, and regulations you have to deal with in running that. So your income needs to be high enough to justify the expense and the aggravation of running the S corp. So really, if you're going to run a sole proprietorship, if you're going to run an LLC, or if you're going to run an S corporation, depends on how much you're trying to grow your business. Okay, if you're just doing the occasional project here and there on the side, it might be a thing where a sole proprietorship is best for you. If you are engaging in more regular business activity and you really want to grow your business, you might need an LLC. And if you're really foreseeing a lot of profits, then you might want to do an S corporation. These are all things to talk about with an accountant. Just be mindful of the fact that the higher you go up that ladder from sole proprietor to LLC to S corp, the more potential you have for business flexibility and tax savings. Okay, as you work your way up that. Which one to pick really just depends on your particular situation, and those are things you really need to discuss with a tax professional. So now that we've talked about all that, let's understand what tax deductions are and look at the importance of making sure you're taking all your tax deductions. Okay, now we're going to talk about the importance of tax deductions and making sure that you're maximizing them. Again, there are a lot of deductions available for small business owners, aka you as a freelancer. So in this part of our video, we're going to look at understanding exactly what deductions are and why they're important. Then we're going to be looking at expenses for your business that can be deducted. There are obviously more common ones that people don't miss, but there are a lot of ones that do get missed. We're going to make sure that you're not missing those. And then the other thing is we're going to look at how you can be maximizing your retirement savings as a form of a tax deduction, and that can greatly subsidize your retirement investments. Okay, so let's take a look at each of these in turn. The first thing to do is to understand the concept of a deduction in general. And for this, I am going to put our slide back up on revenue versus income that we talked about earlier in this video. You'll recall we said that revenue is everything you bring into your business. So in other words, this is everything your customer pays you. But your net income is what you actually pay taxes on. You don't pay taxes on revenue, you pay taxes on income. So let's just say, for example, somebody brought in $5,000, but then they didn't write off their expenses of advertising, insurance, and software subscriptions. That means they're paying taxes on $5,000, even though they only made $4,700. So they're paying more taxes than they really should be paying, which means they're donating money to the government. And that's how I want you to think of it. Not capturing legitimate deductions is essentially donating money to the government. And under our little scenario here, advertising, insurance, and software subscriptions are deducted from revenue. That's what a deduction is. You are deducting something from your business income. You are deducting something from your taxable income to arrive at the number that you're actually going to pay taxes on. So a tax deduction lowers the amount of income that you are going to be paying taxes on. So, what are deductions for a business owner? Again, there are some that are a lot more obvious. There are some that are less obvious. Okay. What you want to do to make sure you're capturing all your deductions is err on the side of making sure, or I guess I should say, err on the side of thinking it's deductible, and then let your accountant figure it out. Because if you have an expense here, doesn't matter what the expense is, but you don't tell your accountant about it, your accountant has no way of ever deducting it off of your taxes, right? So what you're better off doing is just making sure you put all your expenses in all your business expenses into your bookkeeping and let your accountant tell you, hey, this is not tax deductible. Okay. You're better off giving your accountant all the potential deductions and then letting your accountant decide what is and what isn't deductible versus you not giving the accountant all the information and then potentially missing a deduction as a result of it. And then if you miss that deduction again, you pay extra in taxes. Okay. So err on the side of assuming things are deductible when you're doing your bookkeeping and putting your expenses in there and let your accountant straighten that out for you. This is also, on a quick side note, why it's so important to be doing your bookkeeping on a regular basis. So make sure you're keeping your books straight, because if your books aren't straight, chances are you are overstating your income and again paying too much in taxes. So now that we know what deductions are and we know the importance of getting them submitted to your accountant, let's talk about expenses in your business which can be deducted. And for this, I'm going to look at ones that are commonly deducted. In other words, most people know to deduct them, but then I'm also going to look at ones that are less commonly taken because some people may not understand that they can take the deduction. So your common ones are pretty obvious, right? If you rent any kind of office or workspace for your business, then you're going to deduct your office rent. If you pay utilities at that office, you can deduct that. You can deduct services you have to pay for. So if you're paying for AWS in your business to host and maintain stuff for your customers, then that is that AWS expense is something you're going to deduct out of your revenue when you're arriving at your income. Any services you pay for in your business are going to be tax deductible. AWS, if you're paying for office software like Google Workspace or Office 365, would be an easy one. Software subscriptions, like if you're a freelance web developer and you also do a lot of graphics work for your clients, like your subscriptions to a service like Adobe, for Adobe Photoshop and whatnot, is going to be tax deductible. So your various services that you're paying for, are pretty much always going to be deductible, along with things like rent, utilities, liability insurance, things like that. Those are the pretty easy ones, and most people know to deduct those and they don't miss those. However, there are a lot of common deductions that are missed. In other words, deductions that people can be taking, which will lower their taxable income, which will result in them paying less taxes, but they just miss the deductions. They don't know to take them. So let's look at what a few of those are. And there's a bunch of them, but we're just going to go over a few. One of them is mileage and travel. Under the Tax Cut Act of 2017 that created the Qualified Business Income Deduction, or QBI, that we talked about earlier, the ability of business owners to write off their mileage got reduced quite a bit. However, one thing you can still do to write off your mileage is if you are being taxed as an S corporation, which we are in our business. If you're being taxed as an S corporation, it is possible to write off any mileage that's work related. And you do this by having the business, which you own, write a check to the employee, which is you, for the mileage incurred. That becomes tax deductible to the business, But because it's a reimbursement, the employee doesn't get taxed on it. So in other words, it's deducted on the business side and not taxed on the employee side, which means it becomes tax deductible. Okay. And for 2021, if you're driving for work, you can do that at the rate of 56 cents per mile. Now, driving to and from your office, in other words, your daily commute, is not tax deductible, but let's say you got to drive to a customer's office for a meeting. You got to drive to Best Buy to buy a new computer for work. Um, you need to drive to another vendor somewhere. You you know, uh, you you're driving around with a customer to show a customer potential ideas or something like that. You can write all that mileage off at the rate of 56 cents a mile. So that's a really important one to take. Um, if you're using your personal cell phone for your freelance business, you can write off a portion of that. Uh, Again, you can write off the portion that is business related is the thing to understand here. So let's say 40% of your personal cell phone use is related to your business. You can write off 40% of that bill. So in other words, if your cell phone bill is $100 a month, you pay that personally because it's your personal phone, but 40% of it is business related every month. That's $40 a month you can write off as a business expense, or $480 a year, which would lower your taxable income by that much. So when you're using personal things like your cell phone for partial work purposes, make sure the portion of that that's work related is being deducted off your taxes. Equipment purchases fall into the same category as cell phones. Let's say you buy a new laptop, and I'm going to use round simple numbers to prove the point. Let's say you pay $2,000 for it. Let's say 50% of that laptop is used for work, of its time is used for work, 50% of it is used for personal stuff. You can write off $1,000 of that cost. You may have to depreciate it, but that's an issue for an accountant. You'll be able to write off half the cost if half of it is used for work purposes. So that's something to talk to your accountant about. Uh, Travel that is necessary and non-extravagant can be deducted. Okay, so in other words, if you are traveling, like taking a trip, this can include airfare, hotels, meals, things of that nature, and the primary purpose of the trip is for work, and it's not extravagant, you can deduct the work related expenses with that. So, in other words, let's say, for example, I live in Ohio, and let's say I've got to fly to Montana to meet with a customer. The primary purpose of me going is to meet with the customer. I'm not going to Montana for a vacation and, oh, I'll meet with the customer while I'm there. The purpose of the trip is to go to Montana and meet with the customer. I can deduct the airfare. I can deduct the hotel. I can deduct my meals, things of that nature. Now, if I do things on that trip that are purely like personal entertainment, that aspect of it won't be deductible. But the necessary part of it for the business trip, that can be deducted from my taxes. Now, again, it has to be non-extravagant. So, for example, flying coach might be deductible, flying first class might not, things of that sort. So those are things to talk to your accountant about. But if you are traveling for work and it's a necessary work trip, that's something that is tax deductible. So mileage and travel through an S corp, deducting the business portion of things like your cell phone bill, deducting the business portion of equipment purchases of things like laptops, things of that nature, and necessary and non-extravagant travel are just four examples of deductions that people miss all the time. Make sure you're not missing those. Talk to your accountant about them and see what you can deduct. Those are ways to get your taxable income down quite a bit if you have those deductions. And it always does surprise me the extent to which I see people who miss out on those deductions. One of the biggest deductions that most people miss out on is the tax benefits that come from retirement savings. And one of the big reasons people miss out on these deductions is because they don't save for their retirement. That's an entirely different rant. But the one thing to understand, especially if you're a business owner, is that there are provisions in the tax code that allow you to save for your retirement. You can save a lot on your taxes by saving on your retirement or saving for your retirement, which means that those tax benefits help pay for the contributions you make to retirement accounts. Okay. Um, the first way to do this is through an IRA, which is an individual retirement account. Anybody can do that. You don't have to be self employed. Or the second way to do it is through what's called a simple. I'm going to look at the IRA first, and then we will take a look at the simple. The simple is something you'll do if you own an S corporation or an LLC being taxed as an S corporation and you've structured your freelance business that way. So let's start by looking at another one of my less than attractive slides. If you have an IRA, which is an individual retirement account, and I really recommend a book that I'll talk about here in a second. But let's say you have an individual retirement account. For 2020, the 2021 tax year, you could contribute $6,000 to your IRA. In other words, you could put $6,000 into your personal individual retirement account. That $6,000 is tax deductible, meaning if you made $100,000 during the year and then made $6,000 worth of retirement contributions, you would only pay taxes on $94,000. Okay. So since your taxable income goes down, the amount in taxes you pay goes down. So what you see here is that if somebody's in the 22% tax bracket and they made $6,000 in IRA contributions during 2021, they will reduce their annual tax obligations by $1,320, meaning that when you subtract the tax savings from what they paid into the individual retirement account, they wound up with $4,680 costs for $6,000 in retirement savings. In other words, they got $6,000 in a retirement account, but after you factor in their tax savings, it really only costs them $4,680. Okay. And if you keep doing that every year and that money keeps growing, you really get a huge compounding effect on that. And your tax savings are helping fund your retirement. Okay. An even bigger version of this would be if you start what's called a simple. And I'm putting up the slide for that now. And what a simple is it's kind of works. It's an IRA that works similarly to a 401k, and you can do this if you're the owner of an S corporation. So as we talked about earlier, if you own an S corporation, you own the company, but you're also an employee of the company. So what happens with a simple is the individual, which is you, the employee, can contribute for 2021 $13,000 into the retirement plan. The company, which you own, can match up to 3% of the dollar for dollar, can match up to 3% of the employee's savings. So you are the employee, you're contributing $13,000. You own the company, which is contributing $1,800. The individual, where I got $1,800 from it, like I said, you can do 3% of the salary. So I'm assuming a $60,000 salary here, which is where I get the $1,800 from. So someone paying themselves a salary of $60,000 before all their profit can contribute $13,000 to the retirement plan, which they will deduct from their taxes. Keep in mind they have to pay taxes on the company profits, but the company profits are going to be reduced by $1,800. So you're saving $13,000 on the personal side and $1,800 on the business side from your taxes. If you're in the 22% tax bracket, that's $14,800 less that you're going to report in income. At the 22% tax bracket, that means you save $3,177 in federal income tax. So you contributed $14,800 to your retirement accounts, but it really only cost you $11,623. Again, you received retirement savings of $14,800, and when you factor in the tax savings, it only cost you $11,623. Now imagine if you keep doing that year after year after year after year. Okay, and again, that is in contributions from the individual side where you are the employee, and it's contributions from the company side where you are the company owner, and this assumes a salary of $60,000 a year that you're paying yourself before the profit that you would also pay taxes on. So a simple, if you have an LLC that is taxed as an S corp, a simple can be a very powerful way to save on taxes and be building wealth for yourself simultaneously. Okay, and being aware of things like this is how you can really improve, your standing financially. So in terms of deductions, understand that deductions are subtracted from your revenue or income to arrive at your taxable income. Okay. On the business side of things, you get your obvious ones like office rent, things of that nature that are going to be deducted before you figure out what your profit/business income is. You have your less obvious ones like reimbursing your mileage for an S corp, person or business usage of your cell phone, so on and so forth. Those can be deducted from the business also if you do it correctly. Um, Also understand that proper retirement savings can greatly, and I do mean greatly, save you money on taxes. And these are all things, what to be deducting, retirement planning, etc., that you need to sit down and talk with an accountant about, because you can really get into some complicated topics here. But the thing to take from this video is go talk to an accountant and make sure you're capturing all these tax savings, because it will really help you get ahead financially. Okay, so deductions are very important, and make sure you are getting all the deductions you possibly can, and that's how you keep more of what you earn. All right, so now that we've had that discussion, let's talk about how self-employed people will make their tax payments during the year. Okay, let's talk, and I do mean briefly, about making your tax payments during the year as a freelance developer. This is something where a lot of freelance workers and self-employed people get themselves in a lot of trouble, because when you're an employee, paying your taxes during the year is not something you have to worry about. You get a paycheck, your employer does your withholding for you, and at the end of the year, you've been paying into your taxes as the year's gone on, right? Well, when you're a self-employed person, it's your responsibility to make sure those tax payments get remitted to the IRS. And if you fail to make them properly, you're actually going to get hit with a penalty at the end of the year. And unfortunately, I have had the unfortunate pleasure of talking to many self-employed people over the years who didn't understand how to manage their tax payments during the year, and now they have a multi-year debt to the IRS that they may never get out of. I've talked to multiple people in that this kind of sad situation. So when you're working for yourself, understand that you need to be making your tax payments during the year. Your employer's not doing it for you. Okay. Um, if you are running if you're a 1099 worker, running a sole proprietorship, or running an LLC without the S corp election, you need to make quarterly payments through Form 1040 ES. We're going to link to that in the description below. Again, that's Form 1040 ES, and there's an instruction sheet attached to it showing how to calculate your quarterly payments. And you can also fill out a virtual form of 1040 ES by directly through the IRS website. We'll include a link to that below as well, where you would go to make those what are called estimated tax payments for a year. The calculation of your estimated tax payments can get pretty complicated. It's something you need to be talking to an accountant about. The thing to understand is that if you don't pay in enough tax during the year, at the end of the year, you will get hit with a penalty. Okay, that is something you really want to avoid. So talk to an accountant if you're self-employed and make sure that you are paying an appropriate amount of taxes during the year. If you are being taxed as an S corporation, in other words, you're an LLC and you've chosen to be taxed as an S corporation, which is what we do in our business, as we've said throughout this video, you own the business, but you're also an employee of the business and you get a paycheck from the company. So we have a payroll service that manages that for us in our business. And federal taxes and various taxes get held out of that paycheck just like they would any other W-2 job. The problem with that, however, is you have to pay yourself a reasonable salary for the S corp, but then you have profits on top of that. So I get my reasonable salary. Taxes are only withheld on that salary. At the end of the year, I still have to pay taxes on those profits, meaning that on top of the taxes that get held out of my paycheck, I still make quarterly payments to the IRS to cover the taxes that are going to be due on business profits. So we do it by making estimated payments every quarter. Some people do this by uh, cover the taxes on their profits by having extra money held out of their paychecks. Either way is acceptable. It's just important that you talk with an accountant and have a tax plan in place so that you do not get hit with a big tax obligation at the end of the year. You don't want to find out that you way underpaid during the year, and not only do you owe the IRS a really substantial amount of money in short order, but now you've also been hit with a penalty on top of that. That is something you want to avoid. So discuss how much to be paying with an accountant and understand you do it either through Form 1040 ES or through the IRS website. One other thing I'll say on this note, and it's something to talk to your accountant about, is I am not a fan of substantially overpaying taxes during the year. As we talked about earlier in this video, there's a difference between what you pay in during the year and what your taxes are. You pay in taxes during the year. Think of that as, for example, the withholding from a paycheck. At the end of the year, you fill out your 1040 form and it says what your tax due is. What you paid in during the year from withholding or estimated tax payments is offset against your tax obligation. If you paid in more than the obligation, you get a refund. If you paid in less than the obligation, you have a balance due. What this means is that if you are getting a big tax refund at the end of the year, you way overpaid your taxes during the year, which means for 12 months you've been loaning money to the government interest free. Okay, in other words, you've been giving the government more money than you needed to prepay your taxes for the year. They're holding that money, and at the end of the year, they're going to give you back the balance with no interest on it. As we've been talking about through this video, managing your taxes is one of the important ways of getting ahead financially in this world. And the last time I checked, loaning money to people interest-free is not a good way to get ahead financially. So anytime you come across somebody who gets excited about getting a big tax refund, it's important to understand what that person is excited about is that they've loaned money to the government interest-free all year, and now they're just getting the money back. I mean, to me, that's not something to get excited about. Okay, so talk to your accountant. Again, I'm not offering this as personal financial advice, but I'm just saying talk to your accountant. Make sure you're at least paying in enough to not get hit with a penalty at the end of the year, and be mindful of the fact that it may not necessarily be a good idea to loan money to the government interest free. And when you talk to your accountant, you'll come up with the best vehicle for making sure your taxes get paid during this year, whether it's through withholding from your S corp paycheck, or whether it is from making quarterly payments through Form 1040 ES, which again is for estimated payments. But the bottom line to take from this is that one of the things about being a freelancer is that you don't have the benefit of your employer just sending in your taxes for you every paycheck. Now, it's something you need to be managing yourself. So make sure you do it correctly, and that's something to talk to an accountant about. And again, quarterly payments or paycheck withholding if you are an S corp owner. Okay, so let's close out this video by talking about why where you live is so important. Okay, you have made it to the end of this video, and I know taxes aren't the most exciting topic in the world to talk about, but they are really important to getting ahead financially. On that note, the whole point of this video has been about getting ahead financially and the importance of taxes in that endeavor, okay? Where you live matters a whole lot for how much you pay in taxes. You'll always hear people say they move somewhere else because of a cheaper cost of living. Like, for example, I live in Ohio because it is way cheaper than living in a place like California. But what a lot of people don't tend to factor in is what they might be paying in taxes if they live somewhere else. Before my wife and I moved to Ohio, we actually looked into moving to San Francisco. And it wasn't the high rent and everything that caused us to say we're not going to move there. It was what I considered to be an outrageous tax structure in California and San Francisco that kept us from moving there. So, in addition to cost of living, your tax obligation will be greatly impacted. And why is this? Well, like as we talked about earlier in the video, there are levels of taxation, right? You pay federal income tax, you pay employment tax like Social Security, Medicare, Medicaid, but you also pay state income tax and local income tax. Well, those things differ depending on where you are in the United States. Some places have high state income tax, some places have no state income tax, and in some places fall in the middle where maybe there is a state income tax that's not too high, it's not too low, and maybe you pay it and maybe you don't. And some places have local taxes and some don't. So in California, for example, it's a state that's notorious for having a very high state income tax. So if you live in California, even after you've paid the federal government all your taxes that you have to pay to them, you have to pay a big state income tax to the state of California, and you're probably going to pay a local income tax to whatever city you live in. Nevada is on the other end of that spectrum. Nevada has zero state income tax, none. If you live in Nevada, you do not pay state income tax. They also don't have local income tax. Okay, so you're not paying those taxes at all in Nevada. In Ohio, where I live, there is state income tax, but for the most part, self-employed people don't have to pay it. The state credits you back quite a bit of uh, anything you paid in if you're self-employed. You have to make quite a bit of money to pay any state income tax if you are self-employed in the state of Ohio. So so Ohio is an example of a place where going the freelance route not only saves you money on your federal income taxes, it saves you quite a bit of money on your state income taxes, as well. So when you're figuring out, you know, how to get ahead financially, a lot of people do look at, hey, maybe moving to another place will help them because of lower cost of living. You also need to think of tax consequences in there as well. So again, getting ahead financially, if you're thinking of the tax system, it's going to help you quite a bit. And if you're living in a place that really provides advantages to self-employed people, it makes going the freelance route even all that more, attractive. So the one thing I would hope that you really take from this video is that proper tax planning can really help you get ahead. A lot of people fail to consider the fact that their taxes, if they're not their biggest expense, are their second biggest expense. And for most people, they are the biggest expense. Okay. You cannot get ahead financially unless you're getting your taxes under control. It is just very, very hard to do. Remember, people who are well off tend to be well off in part because they think about their taxes. I know this video, as long as it was, really only touched a lot of these topics on like a very surface kind of level. It's because taxes can get very complicated. So that is why it's really important that you discuss these things with a professional. If you are going the freelance route, the self-employment route, and you are working hard at it and making good money at it, it is well worth the cost of a good accountant to make sure you are saving on your taxes. So I hope you found this video helpful. If there are any topics you'd like to see discussed in the future, please drop them in the comments section below and make sure you support Free Code Camp. All right, thank you.